With the United States, you might remember that 1 year ago in this room, what we were forecasting was no recession, so positive economic growth, but anemic, very, very weak, slow growth, well below what David referred to as the post-World War II historical average. We were also predicting that inflation would remain well above 2%, the Fed's 2% target, that while we had started to see disinflation, the headline inflation number coming down, we were predicting that it would stay well above 2%. Now, what's interesting as a context for that is at the time, 1 year ago, in the Wall Street Journal forecasting survey, there's about 70-some economists. Not all of them reply to every survey. And so you see here that there were 68 forecasters responding a year ago. 51 of those believed that we were headed towards recession. Right? We were one of only 17 forecasting houses that predicted no recession. So the entire weight of consensus was on recession. And then what's amazing is not just that we didn't have a recession. What's really amazing is actually what happened almost as soon as we walked out of this room a year ago. What was not in anyone's forecast, any of the 68 forecasters' forecast, was this. On March 10th, the failure of Silicon Valley Bank, and on May 1st, the second largest failure of a U.S. bank in history. Only Washington Mutual's failure was bigger. I remember that one well. I used to commute to teach at a school in Bel Air. From Ventura, I had to drive down Ventura Boulevard. I remember on a fateful day in 2008, driving by the Washington Mutual on Ventura Boulevard and seeing people lined up around the block. We just suffered the second largest bank failure in the history of the United States, and it was in no one's forecast. So this is a challenge to forecasters, right? We didn't see this coming. And this isn't some exogenous event. This isn't a hurricane that damages a community. This is not some geopolitical crisis. This is the financial system we're talking about. And so the question becomes, does this event, first of all, you have to respond to this. You have to update the forecast. The question is, does it what type of modification has to happen? Does it reinforce certain assumptions that need to be strengthened? Do you need to strip away other assumptions? How do you respond to this as a forecaster? Now, that wasn't enough. There was something even crazier that happened shortly after that. In May 1st, second largest bank failure in history, and it was almost moments later that this happened. The S&P 500 went off on a tear and hit repeat all-time highs through very recently. As a forecaster, this also raises some questions. How do you reconcile this? A financial system in crisis and a stock market headed to the moon. Well, what that tells us is that there's a fundamental break, a disconnect between economic fundamentals and price signals like the value of the S&P 500. So what do you do with that as a forecaster? Now, what's interesting to us is this dynamic was actually very familiar. In fact, I'm going to show you now slides from last year. We were actually anticipating this type of dichotomy and showed you these slides 1 year ago. You should remember this. The Dow falls 500 points. This was from January of last year, just before our event. The Dow falls 500 points. Why? Because of solid economic data. The Dow falls on solid economic data. We showed you that headline last year. It works the other way too. Stock market today, Dow climbs 700. Why did the Dow climb 700? Because wage growth was poor. It was below expectations. So the market's been rallying bad economic news and selling off on good economic news for a while. And we drew your attention to this last year. This continues to this day, not just the S&P and bank failures generally, right? This is actually a headline just from last month. Hiring accelerated, 350,000 jobs added. This jobs report beat expectations, not by a little, but by almost 100%. What happens? Right down here, Dow slips after jobs data. And interestingly, it's not just economic data. I really think this is the key. We think this has the Fed's fingerprint on it. The same thing is actually happening with communication from the Federal Reserve. So stocks fall after Powell's remarks on rate cut caution. He said, you know what, we're going to have to hold rates higher a little longer. We don't believe we've gotten a handle on inflation, and what happens? Stocks sell off. So really, when we look back at this previous economic data, we see, well, the reason that good economic news was bad for markets was because good economic news meant that the Fed was going to tighten monetary policy. The reason that markets rallied on bad economic news is because it meant that the Fed was going to maintain the extraordinary intervention in the market that it's been undertaking for years. And so really we see this as one of the key drivers. And so we weren't surprised, right? But again, these are questions that every forecaster has to answer. So what caused the wholly unexpected failure of large banks? And then what has caused this obvious disconnect between prices and economic fundamentals? And then do the events of the last year confirm your answers to these questions, or do you need to update those? And then on the whole, what does this mean for the outlook, right? How do you forecast anything when price signals seem to be broken? Prices aren't communicating important signals about liquidity, risk, and that sort of thing. All right, so I'm going to move through this pretty quickly. Last year we spent a lot of time talking about what are those extraordinary interventions. The Fed did things in 2008 that were never before anticipated, poorly understood, that we predicted would be impossible to unwind. And we think these extraordinary interventions explain they have broken price signals from economic fundamentals, in some cases intentionally, in response to the crisis in 2008 and again in 2020. And the bottom point here is the one I think really matters. What we believe is that what all of that has done, that extraordinary intervention has done, you heard David is sympathetic to this view as well, is that it has created a very fragile economy. And we expect anemic growth in an economy that can't absorb big impacts. I do want to just share this because I'll come back to this when we talk about what keeps us up at night. This is actually a Fed president. This is Kansas City Fed President Thomas Honig. This was what he said about what happened in March and in May, the failures of the banks. So I'll read this because I think it's really important. An entire ecosystem developed around a zero rate, this extraordinary intervention that had never been tried before. It's massive. Now think of the adjustment process. Do you think it's costless? Do you think no one will suffer? You've taken your economic system, you've moved it to an artificially low rate, and then people have been making investment decisions, bets around this new environment. They've been making investments on that basis. They've been avoiding investments on that basis. They've been speculating on derivatives. And now you're going to try and adjust back. You're going to increase interest rates off of that zero bound. Well, good luck. It's not going to be costless. Honig, in the Fed himself, is one of these that really wasn't surprised by the events of March and May. Interestingly, it's not because, in his case, what he's hinting at is it's not because they increased rates too fast, too quickly. It's actually no. The problem was the interventions that they did in the first place in 2008 and that they failed to unwind them in the years after. So, how do you forecast anything when price signals are broken? So I want to share this with you. This is pretty interesting. This is actually, the Wall Street Journal just a few weeks ago released its annual accuracy analysis. And so this just highlights how difficult a year it has been. So notice here, this is GDP, 1 year ahead forecast of GDP, and you see here's actual value where it came in. You see here the average and then the mode, the most, and you see up here that more than 12 people had it here. These are 0.2%. The actual numbers don't matter that much. But what you see is there's this giant chasm between the actual data and the forecast consensus. All of the weight was around recession. Remember, 51 economists. Same thing with the unemployment rate, much lower than average. Now I want to show you where we landed and the person who won. So CERF, you can see here, was actually, we were the 8th most accurate forecast of GDP in the Wall Street Journal forecasting survey among 68 forecasters. You can see here, these are just 1 to 2 for each of these bins. So this was a lonely neighborhood a year ago when we were out here. And in this case, we were actually pessimistic. We were the optimistic ones at the time, but you see that data came in even more optimistic than we were. One point I want to make about this that's so interesting is Dr. Roman. She is a professor of economics at St. Mary's University in San Antonio. And what's interesting is she was not only the most accurate forecaster of the 58, she's a subjective forecaster. She doesn't use structural and inertial forecasting tools, this sort of data architecture that we use. We sort of assume functional relationships between economic variables and future outcomes. And what's interesting is she does a subjective forecast where she thinks a lot about economic theory. She looks at trends. and tries to decide, well, is the trend going to continue or not? And then she writes a number down on a page. Now, and again, this is not to, when I've talked about this in other casts, I've actually heard people snicker, oh, we do subjective forecasting too, and then we do a forecast combination. We use a subjective forecast as a test. Do the numbers the model spit out actually pass the sniff test? Do they make sense, right? And so what's interesting, though, is that it was a purely subjective forecast that won the day. And that hints that, look, if you're using models, these economic variables, that there is a break between price signals and economic variables and underlying fundamentals. But again, what this shows is that it really reinforces a lot of our assumptions. The weight we put on monetary policy variables. These sorts of things are what put us way out here on the distribution. And so again, we actually look at the last year since we were in here, and we actually believe that it reinforces, even the unexpected things that happen reinforce a lot of our assumptions about the economy. And so we're here, we're staying the course, no recession, stagflation, anemic growth, inflation well above target. You see what growth here, actually 3.1% now. This is actually fairly high, being driven by government spending and the surge in immigration of the last 2 years. That's according to the Bureau of Economic Analysis. We see that sort of declining to 1.3. This is a very, very poor number relative to not just the historical record from World War II to 2008. It's even poor relative to the decade following 2008. We believe inflation will stay well above target for the entire forecast horizon, and we actually see, this is where we actually depart from David. I encourage you to listen to his thoughts on the current monetary policy environment. We actually believe that this is the real 10-year treasury, 10 years minus the rate of inflation. We actually believe it's still a very loose monetary environment. It is not a tight environment. In fact, you can see what the last 2 years looks like. This is what tight monetary policy looked like in the early 1980s. And so we see inflation well above target for the entire forecast horizon with a long-run forecast of about 1.3%, which is unfortunate because that's not the kind of robust growth that produces a dynamic labor force that you heard him talk about, right? A dynamic jobs environment that produces upward mobility, social mobility. And so this is work to be done in the United States with a focus on growth. There's real work to be done here. So what keeps us up at night? Well, what keeps us up at night is this just to remind you what Thomas Honig said, is that we really believe that we're in a period where it's a very, very fragile U.S. economic outlook. Yes, it's true that we're not forecasting recession for the year ahead, but I'll make the same caveat that I said a year ago. It wouldn't take much in terms of a large natural disaster, a geopolitical crisis, and we could very easily be into recession next week because it's a very weak economy. Unfortunately, that's not satisfying as a forecaster because we can't forecast hurricanes, natural disasters, we can't forecast geopolitical crises. And so we're holding with this weak outlook, but worry that the economy could be tipped into recession fairly easily. Things that keep us up at night, this is pretty arresting. This is Q3 2020 annual interest payments on the debt. We were paying $500 billion. As of the fourth quarter, we're now paying $1 trillion in interest on the debt. So this is because of the tremendous debt we've accumulated in the last 2 years. It's also because the interest rate increased. And so that's a doubling of interest payments. The CBO just came out and said, in some respects, because of these payments on the debt, the growth in the payment on the debts, future deficits will be numbers that were previously unimaginable. They're predicting $2.6 trillion in annual deficits every single year by 2034. What's amazing about that is they make some assumptions to get to the $2.6 trillion number that are totally unreasonable. They have to score what they're given by Congress, and Congress claims that the 2017 tax cuts and the expansion of the Affordable Care Act that happened during COVID are going to cease in 3 years. Of course, they're not going to cease, and that will add an additional $5 trillion to the debt. They actually predict that they're going to cut discretionary spending to the lowest level since 1930s. That's not going to happen. And the question is, can interest on the debt stay at an average rate of 3.5%? And that is questionable. In fact, if you say those policies are going to be extended, and if you increase the interest rate to 4.5%, you actually get a $3.5 trillion deficit, right? So this is a big problem for the outlook. The other one that we worry about that really keeps us up at night is that we have not even attempted to unwind those extraordinary interventions undertaken in 2008. So you see here, the Fed is still holding $7.6 trillion in assets, and that is not a steep line. In order to bring that back down where it should be, we're like over here somewhere on the wall. And so we really worry that the Fed is going to enter the next crisis still in a posture from the last crisis, right, without having actually normalized those policies and renewed the tools that they have to fight the next policy. And so that's sort of what's keeping us up at night. Now,